Hello, and welcome to the Josh Brown Podcast. With over 40 years of combined financial planning experience serving high net worth clients, we will discuss our favorite topics, concepts, and stories.
Hello, and welcome back to the Josh Brown Podcast. I'm Philip Saunders.
I'm Dan Joss.
And today we're going to be talking about Roth conversions.
Good.
So to start off, what is a Roth conversion? It's taking dollars from your traditional IRA and then moving them to your Roth IRA.
That's right.
Maybe your traditional, maybe your rollover, maybe a simple, I don't know. A lot of different IRAs up there, but moving that money over to your Roth IRA.
Yep. And what happens when that happens?
So a tax event.
Anything you move from the traditional IRA to the Roth IRA gets taxed that calendar year as ordinary income.
Unless there's basis.
That's right.
Yeah.
In the rare event.
So we're getting into the weeds pretty quick here.
You made non-deductible contributions.
Exactly. Yeah.
That portion wouldn't be taxed.
Okay. So let's put that aside for a minute.
There's always exceptions.
There's always exceptions to the rule. But if we just say all tax-deferred dollars, if we move those to a Roth IRA, that's a taxable event in which we're going to have to pay just as if we were distributing from that IRA.
That's right. Ordinary income tax.
So why would we do that?
The simple reason is we believe that the tax we're paying now would be less, the rate of tax we're paying now would be less than the rate we'll be paying in the future when, from a traditional IRA, required distributions begin. Yeah. Which I think is 73 now.
73. It'll be 75 soon. Yeah.
So because a traditional IRA has required minimum distributions at some point in the future, we'll have to take money out of that account.
Right.
And we would do a Roth conversion if we believe the tax we pay now would be at a rate lower than that pending future rate.
Exactly.
And the difficulty is nobody knows the future.
There you go. There you go. That's
so
why
should
we're
you
in
do
business,
a Roth conversion? That depends.
Exactly. There's your answer.
Yep.
Yeah. So you said if the tax rate is higher today, lower today than it would be in the future, and you didn't mean marginal tax, like tax brackets, although that's one of that could be part of it.
The marginal rate.
But it could be other reasons as well. Your income might be higher in retirement due to those distributions that could raise your taxes.
Yeah. The rule of thumb, and you know I hate rules of thumb.
Right.
The rule of thumb is you'll be earning less in retirement and therefore will probably be in a lower bracket in retirement. So you shouldn't do a Roth
conversion. Right.
But many people are doing Roth conversions because that rule of thumb doesn't apply to them.
Right.
In fact, many of our retirees are in the 22 and 24% bracket in full retirement. Mm-hmm. The required minimum distribution adds to their income. If they're collecting, $40,000 and maybe both spouses, so there's $80,000 of Social Security income, plus the required minimum distribution on a $1 million or $2 million IRA. There's you're earning.
And maybe some pension income.
Could be earning,
a lot of our clients
could be earning a couple $100,000 in retirement and not be in a lower bracket than you were when you were 30 or 40.
Yeah. So it sounds like one of the things that we look at is, what's your tax rate today and what's it going to be in the future? And so what life events do we normally look at in terms of, is there a certain life event that we line up with Roth conversions?
There's a window that you should seriously consider looking at. Mm-hmm. If you retire early, let's say in your mid-50s, and your required minimum distributions don't start until your 70s, mm-hmm. You've got 10 or 15 years in there where you're maybe earning less and your retirement income hasn't started yet.
Yeah.
So that may be an opportunity. And Social Security. If you retire in mid-50s and Social Security doesn't start until full retirement age or
Right.
70. You've got your 60s when you may be earning less than you may in your 70s.
Yep.
So that'd be a prime example,
Absolutely.
which is what we do for most people. But we've had clients that are, by some reason or another, are in a zero bracket now.
Right.
Real estate losses, laid off or career changing makes you not earning any income for 6 months or a year or 2 years. That's a window of time when you may consider Roth conversions, because
Right.
zero is definitely less than the future
That's right.
future tax bracket.
Yep. Yeah, and so tax bracket's one of them, and we don't necessarily guess where tax rates are going to go, but something you were mentioning earlier is knowing today. You know what the tax rate is.
Yep.
You know exactly what you're going to pay. You don't know what it's going to be in the future, and so if you're okay with paying the tax today, then maybe that's a good decision for you.
Yep.
Yeah.
And if many people are in the 22% bracket or 24% bracket, and then you add 4 or 5% on for state. 30 years ago, brackets were higher than that, and so I could see them being higher again in the future.
Yeah, I noted that the highest the tax bracket has ever been is 94%.
Mm-hmm.
And
So that would
they've
have been
up
early
there in the
70s
past.
and late 60s?
That was actually at the height of World War II.
Okay.
Yeah, so that was,
So the
but I
50s.
didn't check about you said late 60s.
I said late
That was-
60s.
those
Well,
may
because
have
I
been
know
high as well.
I know Kennedy lowered the tax brackets,
Right.
and then Reagan lowered the tax brackets, and then Bush lowered the tax brackets, and then Trump lowered the tax. So like every 20 years, there's
There's a cut.
there's
then
a
it
cut, and then
creeps
it
up.
creeps for
Yeah.
20 years, and then there's a cut.
Okay.
If that were to continue, and your retirement is, let's just say, 40 years, you're going to have some tax cuts in there, but you also know you're going to have some
high rates
higher
as
rates
well.
too.
Yeah. Yeah. So that's good. That's helpful. The other thing is, the old strategy before the Secure Act, which was a tax act, was that once you inherit these Roth IRAs, you could distribute it throughout your lifetime, right?
Well, Roth IRAs and traditional IRAs.
And traditional IRAs.
You could. There was a required minimum distribution throughout the rest of your life.
Throughout the rest of your life. And now the Secure Act has come along and said, no more of that. No more full life distributions. Now we're going to cut it to 10 years.
That's right. So there's required minimum distributions,
Right.
but the account has to be emptied after 10 years.
Yeah, and so I say that to say that's one of the considerations we use now
Right, because what you're
with
doing,
these Roth conversions.
what you're doing for your kids is, if you have let's say, one child that inherits, if you have one child and you and your spouse are both working, you've got two large IRAs,
Right.
and one spouse dies, you do a spousal rollover. Now the remaining spouse has a big IRA,
Right.
$2 million, let's say, and you're making $100,000 distributions. And then you pass away, your only child will get a $2 million IRA, and they'll have to empty that out over 10 years,
Yeah.
which
Yeah.
would mean adding more than $200,000, assuming some growth on the investments, adding more than $200,000 of income for 10 years,
Yep.
which could bump you up to a higher bracket, could bump them up to a higher bracket
Yeah.
than what you were in.
Exactly.
And so that's
because they may be earning
right.
anyways. and
So to amend our first conversation about the marginal bracket you're in now and paying that versus the marginal bracket you're in retirement,
Yep.
what about
There's one
your
more.
marginal
Yep.
bracket for your children or your beneficiaries? Now, if you have 10 children and a small IRA, then it's not going to significantly change or impact your children.
Right.
But if you have a couple,
Right.
it may.
Yeah, and so that's a consideration we try to think through. Yeah.
Yep.
So going back to
and the difficulty with that is most people's children don't all earn the same amount of money.
Yeah.
So
Yeah.
you may have your own children could be in either a lower bracket or very high bracket.
Right.
Then there's other planning that we could do. It's like, let this one inherit some Roth and let this one inherit, or let's split it up and let's make different accounts with different beneficiaries. Yeah, there's lots of things we could do, which is why we don't like rules of thumb.
Exactly. Yeah.
Other than to put out there and then show why it's wrong.
That's right. Yeah. Yeah, the other thing, so when we started, we were talking about unless there's basis in your IRA.
Mm-hmm.
And so that's another thing that we consider and look at, every year for clients. And so if you earn over a certain threshold, the IRS says, okay, you can put this money in the IRA, but you don't get the tax deduction for it. That means that you've paid tax on that money in the IRA. Now what to do with it? And so that could be another opportunity for a Roth conversion. And there's some things that you got to be careful about there.
Yep.
Are there other IRAs in the picture?
Yep.
There's some things you got to watch for. But that's another reason you might want to do a Roth conversion. And the other that I wrote down that we don't wait on is a market drop. If there's a correction in the market, that may be a good opportunity for a Roth conversion as well.
Yeah, depending on the taxes.
Depending on the taxes, absolutely. Yeah, but I guess I just mean, the market dips. Now your IRA size is a little bit lower. Now let's move some of that over and hope that it rebounds in the Roth IRA.
Yep. And the way we invest with the paying attention to asset location, our Roth accounts may be more equity or more risky.
Right.
They may be more volatile. So getting dollars into that when they're down
and
over time
bounce back. Yeah. Hoping
works.
To bounce back. Yeah. Yeah, and so asset location, making those maybe Roth sometimes a little bit more aggressive, and then the traditional IRAs more moderate.
And you can only do that if you have some dollars in the Roth account, which so we like to have some dollars in each of the accounts.
Yep. I've heard it say different buckets.
After tax, traditional Roth, or traditional IRA and Roth. Yeah.
Yep. Absolutely. Okay. Well, anything else to add to that? I think we covered it pretty well. The only other thing I had written down was on withholding. Sometimes people will make a Roth conversion and withhold some, and so that's another consideration because you don't have to withhold it all. You can make that conversion and then pay the tax from outside accounts, and so that's another consideration that you ought to make when you're doing a Roth conversion.
Yeah, it's a consideration you need to take into account.
Yeah.
I know I'm creating a tax liability for myself.
Right.
What doesn't get me in trouble with the IRS, and what's the best way for me to pay for this? Do I have the money in my trust account to pay that liability, or should I use some of that money I'm converting to pay for that liability? Right. And there's pros and cons to each of those.
Absolutely.
Yep.
So think through that. Yep. Okay, well, so just to sum it up, I would say talk with your tax preparer, talk with your financial advisor, and think through those options.
And there may be, there will be other factors.
Absolutely.
Because the answer may, like the conversation with my tax preparer, my tax planner, was don't convert too much because you have other reasons you want money in your traditional IRA. Like qualified charitable deductions and some other things. Absolutely. So it's not just the tax question, it's your goals question. What are your goals? And there may be some competing goals.
Right.
And so we just wanted to talk about the Roth conversion this time, but there's a reason not to do Roth conversions too. Absolutely. There are many reasons not to do Roth conversions. Many times there's advice givers that say, here's how to do it, and here's why you want to do it, and this is the answer to everything. It's like, well, maybe, but
let's think
you've got your own goals that nobody knows about.
Right.
And taxes, if you can avoid them, is a great thing.
I would say so. Yeah. I would agree with you.
Good.
Yeah. Okay. Well, I think that was good.
Great.
All right. Well, thanks for listening, and we'll see you next time on the Josh Brown Podcast.
Thank you for tuning in to today's episode of the Joss Brown Podcast. If you'd like to see more episodes, visit our website at jossbrown.com.